Okay, good morning. Looking forward to the day ahead. Let's just try and make sense of some of that movement from yesterday first. It's a big day ahead though. Plenty of data, well, we've already had plenty of data to come this morning. Big events this afternoon, both sides of the Atlantic with key US data. We've got, of course, an ECB monetary policy press conference, and on top of that, of course, the ongoing Greek saga. We're heading into the end of the week where we're going to get an OPEC meeting. We're also going to get the key non-farm payrolls data, and the result of all of this sort of cocktail of forces is pretty big market movements, to say the least. If you're looking at my charts here, then the top two, perhaps, these are the equity markets, the S&P on the left, DAX on the right, and certainly the S&P doesn't reflect at all what is happening out there in other asset classes, but also in other equity markets, because there's a big contrast between how this S&P is performing relative to the DAX. We've got a pretty pronounced downtrend here for European stocks, and that's really over the last few weeks, whereas the S&P seems to be stubbornly flatlining. I say flatlining, I mean it's moving sideways, but it's moving sideways in a pretty noisy, choppy fashion. But ultimately we still trade up above the 2100 handle, and apart from a brief foray below there a few times yesterday, here we are still up 2108. So the US equity space remarkably neutral. That is definitely not the case for other assets, particularly the bond space and the FX space. Yesterday, big moves. I mean, just have a look at this bond market, the Bund here, bottom centre, for the last couple of sessions, and yesterday particularly, but really the last couple of sessions, again, this is very reminiscent of the end of April, beginning of May, the bond market rout. And actually, and I said this yesterday, I'm just going to move to a daily chart here on the Bund, just to show you that end of April, start of May collapse. Well, look at yesterday's candle. That is bigger than any single down day we saw during that collapse at the start of the month. And indeed, this was the biggest down day for the Bund of 2015. I think you've got to go back, I think it's August, something like August 2012, I think I'm right in saying, in terms of the last time we saw the Bund go through such a dramatic intraday move. It was over 200 ticks, and this is exceptional, to say the least. And you can see we've got some downside bias this morning again, trading down below yesterday's lows, and there's an obvious target, of course, and that is 151.44. Just going to add another line in here because we've got a second sort of preliminary target just around the 152 handle, which was the low mid-May, but it's that 7th of May low that is the key target. And if you're trading this Bund and you're thinking, well, that day yesterday was absolutely extraordinary, can this thing continue to move lower given the scale of the movement yesterday? Well, the answer to that is absolutely yes. If you just look at a weekly chart, or indeed, we're still pretty lofty levels, and if you look at a monthly chart, well, we're still at the very, very top of what has been a multi-year rally, and indeed, well, let's take this even longer, shall we? Let me see, can I go to let's go to a quarterly chart. I don't know how far I can go back here, but you can see this isn't just a post-financial crisis rally, this is part of the 30-year bond market rally. And so when you get this into perspective by looking at the ultra long term, where this Bund trades is right up at all-time highs still, despite the fact we've had a phenomenal move lower. Of course, we are still very, very high. So you've got to keep in mind this long term when you're thinking about today, and can the Bund move lower given the scale of the movement of the preceding 2 days? The answer is definitely yes. So maybe let's just talk about this move yesterday, and I want to just slide that across. I'm going to just enlarge my euro dollar chart. These were the two big markets of the session yesterday, undoubtedly, and it's pretty odd perhaps when you're looking at this and you're thinking, well, hang on, so the big risk of the week is Greece, and the Grexit risk is top of the list. It's, who knows who knows what's going to happen over the next couple of days. You can't call it. It's a 50-50 whether Greece default on Friday or not. If not, a higher likelihood than 50% of a default. I mean, it's hard to put a number on it, but clearly the uncertainty is extreme. And so you might have thought, well, hang on, if Greece are going to default, shouldn't both these markets be moving in exactly the opposite direction? Shouldn't you get the euro weakening? Shouldn't you get safe haven European debt rallying? Except no, it's going not only in the opposite direction, but aggressively in the opposite direction. So I think what went under the radar a little bit yesterday, and it went under the radar because we're so obsessed with Greece, but the inflation figures yesterday from Europe weren't massively surprising, because we had German data the day before that indicated that inflation levels had ticked up. But if I just show you the European core inflation chart, then maybe this helps to explain some of that movement yesterday. And as I said, it went under the radar. I think we were certainly guilty of perhaps not quite giving this number the significance it deserved. But 0.9% was the core inflation print. That matches that August number from last year. And if you take this chart back a little further, let me see if I can just take it back to like 2011 here. Sorry, let me get this loaded up. Then what we've had over the last few years, of course, is a downward trending inflation situation, both on the headline CPI, but more worryingly on the core inflation, that dipped below 1% in 2013 and has been in a pronounced downtrend. Now, is that 0.9% print yesterday, is that the reversal of this 2-3 year downtrend on core inflation? I don't know. I mean, it's too early to say. We need another few data points here in the months to come. We need core inflation back above 1%, and then we can start genuinely saying, well, this cycle lower inflation in Europe's done. And this is maybe why we got the big movements yesterday, which created correlated moves elsewhere. And I'll talk about T-notes in a minute, but now I've talked about that, this 100% explains what's going on with both of these markets yesterday. When inflation ticks higher, long duration yields move higher. So this is the Bund selling off aggressively, really accelerated by this core inflation print yesterday. Then on the opposite side, well, higher inflation, this is, you've got to start thinking about, well, what does this mean for ECB quantitative easing? And again, it's way too early to start suggesting the ECB are going to start tapering their QE program. It's way too early, but it still perhaps introduces the idea that is more likely than it used to be. Even though it's still very unlikely, it's slightly more likely than it was, given what's happened to inflation over the last few months. So if you're starting to think along the lines of, well, the ECB committed to 60 billion euros a month for 18 months, but maybe, given what's happening with inflation here, and given how obsessed the Eurozone is with inflation, and given how obsessed particularly Germany is, and how fearful they are of high inflation, well then if inflation carries on now turning and trending back higher, there is a realistic chance to say that the ECB will never deliver this full package that they promised back in January. So this helps to explain, I think, the Bund movement. It certainly helps also to explain the Euro movement. Now, the Euro movement, just switching to FX, was part of a broader-based dollar weakness. We had dollar weakness against everything yesterday, but it was the Euro that really led that. It was the Euro popping up above the 110 handle and a huge amount of short positions getting squeezed out and stopped out. If you're trading the Greek risk and taking your eye off the inflation ball, well then you're aggressively short euro, and these guys got killed yesterday as the market was driven higher by inflation, and then that drive higher got exaggerated and accelerated by short positions getting stopped out, and you had this phenomenal move up to the 112 handle. Now, we've been consolidating ever since, but the euro is kind of on the low point of the session at the moment relative to the dollar. But just talking about, so these were the two key markets, and then these markets had effects on everything else. If you think about T-notes yesterday, it was if you ignored the Bund, well then it was a no-brainer long on T-notes yesterday. That's because the US data was bad, and we had dovish comments from the Fed. The Fed's barnyard was dovish, and we had more bad data, so that's dovish as well when you're starting to try and think about Fed rate hike timing. So if you're just looking at the US yesterday, well, T-notes should have rallied, except they didn't. They sold off pretty sharply, and that's because they got dragged down by what was a broad-based global move on long-term government debt, and that's yields rising everywhere, and rising quite steeply, and particularly, of course, in Europe. So these were the two big markets yesterday, and it was, I think, triggered by the inflation print that kind of went under the radar because we're so obsessed with what's going on in Greece. So a pretty remarkable session. Let me just rearrange these charts. What happened with European equities was more downside. Again, headline risk is huge at the moment with the Greek situation, and we had plenty of more headline risk yesterday. What we do know now is that this meeting on Monday night in Berlin between the key Eurozone creditors culminated in a set of proposals that is going to be delivered to Tsipras today. Now, it's most likely these set of proposals are not going to be acceptable for Greece. I think we are in the situation where both parties have decided the furthest they're willing to go in terms of making concessions, and they're probably not prepared to go any further. It's just that but both sides' concessions do not mean they meet in the middle. And so ultimately, the Eurozone want large primary surpluses. They want control. They want promises about further fiscal reforms and adjustments, and they want the Troika to be in charge of enforcing the deal. Now, what Tsipras has is a political agenda for none of those three things to happen. He was voted in by the Greek people on the mandate that austerity would stop, on the mandate that the Troika would stop having control over and forcing fiscal austerity. And so here's the position, and I don't know. I said it's 50-50. Are Greece going to default on Friday? Personally, I think it's higher than that. My personal view is I can't see how a deal's going to be done here. And we'll see what happens on the other side, but this could be one of the most remarkable economic events in history, and I'm not exaggerating. We'll talk about this today further, talking about some of the options Greece might have if they did default, if capital controls were implemented on the Greek banking system, preventing Greek people getting access to cash. The problem with that, of course, is Greece is a cash society. That's because they avoid tax, and paying cash means they can avoid it. So if they can't get hold of the cash from the banking system, how can the economy operate? And there is one solution. I mean, it's very complicated and messy, but this is using basically deposit receipts, which would effectively create a Greek euro. We'll talk about this later, but there are options. There is options. Just because Greece default doesn't necessarily mean they're going to leave the Eurozone or the single currency. But anyway, we'll talk about that later. Now, so be aware, Greek risk is still obviously top of the agenda. And we got Mario Draghi talking this afternoon, and it'll be very, very interesting to get his take on the latest developments and the fact that here we are 6 weeks on since the last ECB meeting and still no deal. And what is Draghi going to do if on Friday Greece fail to make their IMF payment and technically default? What implications does that have for the Greek banking system having access to the emergency lending window at the ECB? So he's going to get some big questions on that, and it's difficult for him to answer them when we don't know yet. I mean, it'd be better if this meeting was on Monday next week, so at least we could get past Friday and have a better idea as to where the near-term future direction lies for this saga. But he's going to be, of course, asked about Greece. Other stuff he's going to talk about that he will deliver information on is the front-loading of the ECB QE programme. Of course, we've had comments on this a few weeks back now, where the idea is that the ECB are going to buy more than 60 billion euros of assets in June, and in May actually, because they fear that the summer shutdown for the European economy will lead to insufficient amount of assets for them to deliver a 60 billion euro package. So they're going to front load it. So we want information on this. How much are they going to front load it by? How many assets are they buying this month? And therefore, what's the reduction looking like in August? And are they going to backload it as well? Are they going to spread this into September or maybe October? We want to know the scale of the front loading or the back loading. So this is important information. Also, I'll be interested to see what Draghi thinks about the inflation developments and what he thinks about this turn higher in inflation, and do the ECB see this as sustainable? Do they see this as potentially altering their QE package? He'll be asked about this. He will not answer those questions. He will absolutely not commit to commenting on whether the QE program is going to change in size because of the inflation situation. It's too early. Maybe in a few months' time, if core inflation's above 1% and has been for a couple of months, then maybe he might hint at it. But I don't think today. I think it's too early. Right, so important session. More Greek headlines coming, of course. Tsipras meeting Juncker in Brussels today to discuss this new set of proposals that the EU creditors have finalised on Monday night. So, of course, comments out of that are going to be key. On top of all of that, let's just bring in the data calendar, because plenty of other stuff happening. You need about 10 set of eyes today. So we've got European data. We're just about to get the services PMI number from France. We've already had China numbers overnight, which are pretty decent. Japanese services PMI also beat expectation marginally, not massively beating, but slightly positive. So we've got France, Germany, and then the EU as a whole at 9 a.m. These figures are the final readings. We had the preliminary numbers a couple of weeks back. Let me just get... we had the preliminary numbers a couple of weeks back, and so it's not likely these numbers are going to be that different. We've already had Italian PMI numbers that came in slightly lower than expected. We're just getting French numbers into the system here. But these numbers aren't going to generate too much action, I wouldn't have thought, given that they're the final readings, plus also we've got bigger fish to fry today, and that is Greece and that is ECB press conference. But this will keep us on our toes as we go through the morning. The services PMI out of the UK as well. Probably more interesting than the PMI numbers will be the EU retail sales figures for April. These are due at 10 o'clock. Then we move down and we get into the thick of the action from the US, and we've got the ADP employment change. Let me show you the chart for this. It's been declining for 4 months in a row, or even 5 months in a row now. 2 consecutive months below 200,000. And today, if I flick back to the calendar, what we're expecting today is for 200,000. So that would be a rebound after a couple of weak months, looking for this figure to get back up with a 2 handle. But so this will be an important gauge towards payrolls. I say that, but I mean last month the April readings weren't particularly insightful with regards to giving us a lead indicator to payrolls. The ADP number disappointed, and yet payrolls came in well above 200,000. So whether this is that useful as a lead indicator, I'm not so sure. But if you do get a dramatic number here on the ADP, either way, let's say it comes in below 150, then certainly it's going to create movement. Let's say it comes in at above 220, well then that'll create movement as well. Anything around 200, and it's probably going to be an event that's going to go fairly unnoticed because this data is being announced just 15 minutes before before Draghi starts speaking at the ECB conference. So 115 ADP, 130 Draghi, plus trade balance for April for the US. This is important for Q2 GDP guidance. Okay, so trade balance figures coming at 130. Services numbers at 2:45 and at 3 o'clock. Then we get the Department of Energy numbers at 3:30, and we're expecting another drawdown, 2.5 million barrels on the headline. Let me just go back to my charts here and just quickly look at oil, which has been benefiting from some dollar weakness, and we're just ticking lower today, and anywhere around here, that high point from last week, $60.70, that was also the high for Monday. We've just been chopping around that area this morning so far, but oil benefiting to a certain degree from that dollar weakening move yesterday. Of course, we got the OPEC meeting on Friday, which is a big event, obviously, and so it'll be an interesting afternoon for crude oil. Keep your eye on the dollar movements, but then, of course, the Department of Energy numbers will take the lead at 3:30. So, lots to think about. A huge amount of different types of influences here. We've got political forces coming out of Europe. We've got bond yields moving all over the place because of people thinking about the more sort of medium-term inflation outlook. We've got big monetary policy event in the Eurozone. We've got some key economic data, and it's all in the melting pot. I would say that we're going to get big movement. As I said yesterday, we're going to get big movement, I think, over the next few days and maybe even weeks. And so it's important from a trading point of view not to get frustrated by missed opportunities. Let's talk about the euro yesterday. It was such a big move, particularly around about 2 o'clock when we pinged higher, a sort of 150 pip breakout up to the 112 handle, and you sit back and you think, wow, if only I was long that instrument, that would have been the trade of my career. But you can't think like that. You can't reflect on missed opportunities, and just be reassured that more opportunities will come. And don't think that these opportunities are easy to take either. So again, that might help with your frustration levels if you're in the knowledge that trying to time some of these big momentum breakouts is very difficult. And so there will be more opportunities. If you miss one, don't let frustration drive your decision making from that point. Don't move into that zone of feeling like you've missed out, or even if you've lost money from a move. If you were long the euro yesterday and lost money, and believe me, some of you listening to this did exactly that, then that's very difficult to try and deal with mentally. But this is why you've got timing's everything. Don't see a move, see that you've missed it, and then jump on it late. And also, if you've lost money and you feel like you've been a little bit robbed, well, then that's life. Don't let that factor lead you down that path of wanting revenge. As soon as you're on that road only leads to one place, I can assure you, and it leads to that place where your P&L looks very ugly and you've been stopped out for the day. Nobody wants to be there. Nobody wants to be in that place. So when you feel like you're on the road to that place, when you feel like you've got some revenge, anger tendencies, you've got to have the mental discipline to step back. Go and have a walk, I don't know, buy a punch bag, go and get a coffee, whatever you need to do. Just remove yourself from the screen if you feel like you're stepping onto that path. It's very difficult to do that. You've got to have a lot of mental discipline, and you've got to know yourself. And so it's not easy what I'm suggesting here, but just keep that in your mind. Try and keep a gauge on your mental state as best as you can. All right, so plenty of action today, I promise. Lots of stuff going on. There's going to be opportunities throughout the day, so if you miss one, don't worry, there'll be more, and enjoy the day. Thanks.